Invest smart with Bullsmart. In the investment world, building a portfolio centered around funds is a key part of smart financial planning. By investing in funds, you can grow your wealth in many ways while staying steady through ups and downs of the market. This video is all about how to create an awesome investment portfolio using just funds. We'll talk about why is it important, the perks it brings, and how to put it together step by step. Plus, we'll focus on choosing the right mix of funds for your portfolio. First of all, let's get why an investment portfolio is a big deal. It's more than just spreading your money around. It's an awesome tool for managing risks, helping you stay calm when the market goes wild. By putting your eggs in different baskets, you lower the risk of putting too much faith in one asset or market. When the economy or market changes, a well-mixed portfolio is your shield, balancing risk and reward. Diversifying your portfolio doesn't just spread out risks, it's packed with other benefits too. For example, it helps you ride the waves of economic ups and downs, aiming for solid returns no matter what the market weather is. Also, by mixing different kinds of assets, you can aim for growth while keeping cool during market swings. Got the why and what? Now, let's dive into the how. Creating a fund-based portfolio is a detailed task. You really need to get the market and align it with your personal goals and how much risk you are comfortable with. Here's a step-by-step guide. Number 1. Set your goals, what you are investing for. These goals shape your strategy, like how long you are investing and how much risk you are up for. For longer-term goals like retirement, you might be okay with more ups and downs, while short-term goals like buying a house might need safer bets. Number 2. Know your risk appetite. Figuring out how much risk you can take is key. This helps you pick the right type of funds, whether it's growth-focused stock funds or more stable bond funds. Number 3. Plan your asset mix. This is about splitting your money across different fund types, based on your risk taste and goals. If you're all about growth, you might lean more towards stock funds. If you're looking for stability, putting more weight on bond funds might be the right choice. Number 4. Choose your funds. Now, you get into the specifics. Look into the fund's past performance, how much it costs, and the fund manager's strategies. A variety of funds can help spread out risks and boost potential returns. Building a fund-based portfolio isn't a one-and-done thing. It needs time, patience, and regular check-ins. By smartly picking and managing your funds, you're taking solid steps towards your financial dreams. So, you've got a basic idea of how to build a portfolio. But here's a crucial step. How to mix and match your assets? Diversification is key. It's about spreading your investments across different types to lessen the blow if a particular market or asset type takes a hit. In a fund-based portfolio, this means choosing a variety of fund types. Stock funds. These are great for long-term growth seekers. When picking stock funds, think about different market regions like emerging markets, industries like tech, and company sizes, whether big or small. Stock funds are riskier but have more growth potential. Bond funds. If you want steady income and less bumpy rides, bond funds are for you. You can choose from government bonds, corporate bonds, or high-yield bonds. They're usually safer than stock funds but with limited growth. Money market funds. These are the safest investments in short-term stuff like government bonds and commercial paper. They offer lower returns but are super safe, often used as the cash part of a portfolio. Balanced and sector funds. Balanced funds mix stocks and bonds, perfect for medium risk seekers. Sector funds like bank funds or tech funds let you focus on specific areas. When it comes to figuring out how much of your portfolio goes where, think of it as striking the perfect balance in your asset mix. This balance should align with your personal investment goals and how long you're planning to invest, while also fitting comfortably with the level of risk you can handle. For instance, if you are the adventurous type, aiming for long-term goals like retirement, you might lean more towards stocking up on stock funds. On the flip side, if you've got short-term dreams like buying a car, it's probably wiser to cozy up with more bond funds and just a sprinkle of stock funds to keep the risk of losing your dough low. Here's the kicker. As life rolls along and things change, like your personal situation, how the market's doing, or even what you're aiming for, your plan for splitting up your assets should get a refresh too. It's all about staying in tune with your goals and the world around you. Wrapping it up and setting your fund-based investment portfolio is pretty much like planning a road trip to your financial dreams. You've got to figure out where you want to go, how fast you're comfortable driving, and what kind of fuel you need. It's all about making smart choices, keeping cool when the road gets bumpy, and maybe even changing the route as you go. Do you have more questions about the fund portfolio? Stay tuned. We will have more videos talking about this topic.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.